The new era is corporate tax. The old era in 2018 was the VAT. And before that in 2019 is what? Economic substance regulation. So let's start with level 1. First, you need to understand what is your tax dragon training ground. That is your first tax period. If your fiscal year is your calendar year is January to December, then your first tax year is January to December. Simultaneously, it will be 12 months period. And you have to register for corporate tax mandatory, even if you don't have any revenue or you are inactive company. Otherwise, late tax registration, your dragon is going to bite you 10,000 dirham straight away. But you need to understand your dragon's language. And your dragon's language in UAE is dirham. If you're a MNC or your accounts are being prepared in other currency other than AED, you have to convert them at central bank of spot rates. Transaction-wise, if that's impractical, then you can do it on average monthly basis. Alternatively, you can do a yearly annual average rate, you can use it. But remember, whatever rates you are using, it should be documented and the rationale has to be documented. If there is a change, in that case also, you have to maintain the rationale. Second, you need to understand your dragon's language is IFRS. If you are a company whose revenue is more than 50 million, or if you are a qualifying free zone, you are mandatorily required to have audited accounts and maintain full IFRS. For companies with revenue less than 50 million, you can use small IFRS for SMEs. If you are a small company, below 3 million, you can use the cash basis accounting. You need to understand what is your corporate tax rates. Corporate tax rate is applicable 0% up to 375,000 of annual taxable income, and above 375,000 will be subject to 9% standard rate. Taxable persons income is worldwide taxable in the UAE. That you need to understand. This 375,000 is not easy to calculate. You have to make 8 adjustments. First, you need to see what is allowable and what is disallowable. General rule, all businesses expenses are allowable. If they are in capital expenditure, they are not allowable. You can deduct from depreciation. Interest expenditure, 30% of EBITDA is allowable. Rest of it, you can carry forward. Disallowable, fines and penalties disallowable. Dividends and other profit distribution paid to owners of the taxable person or the salary drawn from sole establishment are disallowable. UAE corporate tax cannot be deducted, and irrevocable input VAT you can deduct. Now you need to determine where is your dragon's domain. You can be a resident person, you can be a non-resident person. In both cases, you have to pay the corporate tax, you have to get registered. This resident person then can be found in 3 areas. Entities incorporated in the UAE and its branches, foreign entities controlled and managed in the UAE, and third is the natural person. Incorporated in UAE means both mainland and free zone. The taxation of branches will be subject to main company because they are the extension of your parent company. You don't need to register them separately. You don't need to find and calculate the taxable income separately. Whereas foreign branches of foreign companies, they will generally be subject to UECT unless you have applied for the exemption. Foreign entities controlled and managed in the UAE means that you are resident of the UAE, all board of the meetings are held in the UAE, and you are controlling that company even in Cayman Island, in BVI, anywhere. You need to get it registered in the UAE and you have to pay the taxes in the UAE. If you are a natural person, you are good to go if your revenue doesn't exceed 1 million in a calendar year, because for natural person, the calendar year is the Gregorian, January to December. That will always be the case. If you exceed 1 million, then you have to register for CT. Otherwise, you don't need to register for the CT. And 3 exemptions natural persons are enjoying, that is wages, personal investment, and real estate investment income. Now, coming to the non-resident person, there are 3 dens of this tax dragon. Number 1 is the permanent establishment, which is subject to 9%. Number 2 is the nexus in the state, which is subject to 9%. And the third one is the UAE source state income, which is withholding tax, which is currently 0%. If you're permanent establishment means you have a fixed place in the UAE from which you are conducting your businesses. It could be a branch, office, factory, but the criteria is 6 months. So once you reach the 6 months for permanent establishment, then you have to register for the CT. Permanent establishment could be done through an agent, that you have an agent who is working on your behalf and he is finalizing your contracts. State source income, which is currently withholding tax is 0%. So those foreign resident, non-residents can enjoy unless the rate has been defined by the authority. Foreign non-resident person can derive sources of income from withholding tax, which is 0%, could be from resident person, non-resident person having a P in UAE. It could be derived from activities performed in the UAE, assets located in the UAE, capital invested or rights used in the UAE, or services performed or benefit in the UAE. The last one is that, you need to determine your dragon's den. Nexus in the state. Nexus in the state means you are a non-resident foreign person and you hold immovable property in the UAE and you're earning rental income or any other income from this property that is subject to corporate tax in the UAE. Now coming to the main interesting part, now mainland versus free zones. So you need to assess, is your current setup maximizing your tax benefit? Are you in a free zone? Are you eligible for 0% tax scheme? Or you need to analyze your business needs and choose the best fit, or you need to do the restructuring, how to avail 0%. So free zones are in a safe zone. And the most interesting part is that His Excellency Mr. Ismail Naqvi is here, which is the designated zone. So if you want to open a company in a designated zone to avail the trading distribution business, you can contact him. But for free zone 0% scheme, you need to fulfill 5 criteria. You need to maintain adequate substance in the UAE. You need to have audited financial statements. You need to maintain de minimis requirement that non-qualifying revenue should not exceed 5% of the total revenue. You need to apply arm's length transaction, and you need to not to elect 0% tax rate in the time of filing of your first return. These are the 13 qualifying activities, and there are 5 excluding activities which will become the part of your non-qualifying revenue calculation while calculating the de minimis requirement. Now, as we have seen that there are 3 dragons, and you need to integrate the 3 heads, the VAT, the corporate tax, and the ESR. In ESR was implemented in 2019, and there are 9 activities. These are called relevant activities. But why we are seeing the ESR? Because if you want to avail the qualifying free zone percent 0% scheme, you have to comply with the economic adequate substance. And adequate substance was previously introduced in ESR. You need to have core generating activities conducted in the UAE. You need to have adequate employees capital expenditure in the UAE, and if you are outsourcing your core generating income activities, then you should be supervising them. Now the key steps to tame your tax dragon, which was implemented in 2018, is first you need to know the VAT registration threshold, VAT rates, and deadline for VAT return filing. There is still confused people who came to us and they say that are we supposed to register for corporate tax because their threshold has not met 375,000. So in case of VAT, you have to register for VAT when your threshold meets 375,000. But in case of CT, if your revenue is 0, if your company is dormant, if you are inactive, even then you have to register for corporate tax. VAT filing is determined, return period is determined FTA based on your revenue, I think monthly or quarterly. But corporate tax is paid high sea sales and third port shipments. In VAT, if you are doing third port shipment, that means that goods are not crossing through or not landing in the UAE, but you're buying from one country and selling it to another country. In VAT, it is out of scope. But in corporate tax, if you're doing the same activity through a mainland, it is subject to 9%. Only exemption in the case of designated zone. If you're doing it from a designated zone, then it will be subject to 0% you can avail. That is Mr. Ismail's Ajman free zone. These should be there two criteria. Either you are importing those goods in the UAE from a designated zone, or those goods are already being imported or manufactured in the UAE and you are just selling them across UAE or exporting them through other countries, then you will be subject to 0% corporate tax meeting all the 5 criterias. Now let's tame your tax dragon. You have to familiarize what are your related parties and your connected persons. If you don't read them fairly, this tax dragon is going to bite you. So you have to control the breath of this fire-breathing dragon. What are your related parties? As an individual, you're up to your 4 kinship, your relatives, your great-great-grandfather. For individual, for legal persons, if you're controlling 50% in their shares. In unincorporated partnership, all partners for trust, trusters, trustees, settlers, all are your related parties. And connected parties are your company's directors, officers. Any transaction you are doing with your related party and connected person, you need to look for the deals between you and your dragon cousins. If you don't do that, then FTA is going to do adjustment for you and to the counterparty as well. There is another relief. I will call it a relief. If you have a multiple companies, try to figure out to make a tax group. But in that case, you have to hold 95% shareholding in those companies. So you can transfer your losses subject to certain conditions. Another thing is a qualifying group. In that group, you don't have to make a tax group. You can transfer your losses if you have control over 75% of the shareholding of that company. Now it's time to slay the paper dragons. If you have opened so many companies in the UAE and you are not using it, earlier it was a tax haven, now you need to close them. And remember, as per FTA guideline, before closing those companies, you are mandatory required to register those company. Then you have to file a liquidation report which is issued by an auditor, and then you have to file for the deregistration. If you fail to do that, there is a 10,000 penalty on non-registering of those company, and at the time you will be opening another company, you will not be issued a license from the authority. Don't forget to feed your dragon. You have to update them with the reliable sources, new updates. And you have to keep the records also. And for transfer pricing, if you are a MNC with 3.15 billion revenue, you have to maintain the master file, and 200 million, you have to maintain the local file. And there are certain other requirements, CBCR and disclosure forms. If you are still tired and confused of training the dragon, I'm your tax dragon slayer. Contact me. And that is the end of our Dragon's Training Manual. Thank you very much.